Hello, everyone. Thank you so much for taking time on a Saturday evening to join us for this webinar. And I'm sure you will not regret spending the next 60 to 90 minutes with us. So today we have none other than Devina Mehra. It's often said before her introduction that she needs no introduction, and that's because it's true. She's been, an integral part of the financial markets in India and globally for over 3 decades now. And she's a founder of First Global, and she heads all activities here, including heading the investment committee. I am Achin, as some of you might know. I head the quant research at First Global, and the topic that we have for today, it's a very very fascinating topic. We'll try to deal with a lot of the questions that all of you will be grappling with in the current time. So we'll share our thoughts on that and how you can, get your thoughts together in periods like this. That being said, I'll hand it over to Devina to kickstart the presentation. Devina, over to you.
Thanks, Achin, and thank you all for taking the time on a Saturday evening and thinking this is a fun activity, because I'm sure most of you think that markets haven't been much fun of late. So I hope besides being an illuminating half an hour presentation, it will also be an interesting and fun time. So let me start right away. I'll have, I think the presentation is about 25 minutes or so. And then we can have the Q&A. So Achin, can you start the screen share? Right. So there's been huge amount of news flow of late. In fact, over the last few quarters, even years, there's like a lot of stuff happening all around the world. There have been market crashes. There have been news on inflation, on what happens to growth all over the world. What are the policy decisions central banks are taking? What are governments doing? And it's like a whirlwind. So it is another million or billion dollar question is that what do you do in the markets now? What should be your investment strategy? And that is something we will be addressing now. So it's, as the Chinese proverb goes, that you don't want to live in interesting times. But certainly we have been living in interesting times right from the pandemic starting in 2020. We've not had just one black swan event, probably more than one, because there has been this Russia-Ukraine war of late, which was not predicted as of January. I was looking at the Economist's 10 big risks for 2022 when the Russia-Ukraine conflict didn't even make it to the top 10. Then, of course, because the pandemic itself has not run its course, you still have those shutdowns, reopening, suddenly Shanghai shuts down, something else happens. There have been major supply disruptions because of the pandemic, because of bottlenecks, physical bottlenecks. There have been the war, there's been decades high inflation which has not been seen in many people's living memory. And as I said, there have been policy changes. So all these are the backdrop to which you are seeing that the markets around the world have also reacted. And you've seen markets around the world sliding to a greater or lesser degree. So you have almost all markets around the world reacting to all this news and negatively at that. We were just looking at year to date, which are the markets which are in the positive territory at all. And that's a fairly short list, mostly of commodity-oriented countries like the South American countries like Chile, Colombia, Brazil, or you have the energy majors like Saudi Arabia or UAE, Indonesia, which has agri-commodities. Turkey is a quirky thing because of their underlying problems. Their actual equity markets have done well of late, but that's a not a very representative number. So if you look at where the markets that most of us track, India and US are. So India is number 20, down 15% about. S&P down 22.5. NASDAQ is almost the worst performing index in the world. So out of 40, 41 indices, this is almost at the bottom. So below that, of course, you have Sri Lanka and Poland, I think. So that's about it. And so it's about the worst performing index in the world. Inflation, as I mentioned, is at decades high around the world. So In the US, it's at 40-year high. In Spain, also about 40-year high. Germany, almost 50-year high, 48-year high to be exact. Around the world, inflation is between at least 25, 30-year high. Even India, of course, has had inflation off and on. But if you look at wholesale price index, the WPI inflation is at a 30-year high. And I'm not just talking one print, I'm talking the whole year of financial 21-22. WPI inflation was over 13%, which has happened after 3 decades. So everywhere inflation is high, and what that is doing is that is prompting the central banks in order to keep a cap on inflation to push up interest rates, because that is the one tool they have available to cap inflation and inflation expectations, which is to push up rates. So what happens, just let me just digress a little bit. I mean, many of you know, if you here will know that, but just for people who do not understand why interest rates are relevant for markets, and in fact, they are relevant for all securities, for equity, for fixed income, because all security holders, what is the value of what they hold? It is a discounted value of all the future cash flows. So there are a few things that happen. One thing very distinctly, as the interest rates in the economy go up, are here in the denominator, which is the discount factor goes up. So the risk-free rate goes up. So everything, like let's say equity is discounted at an equity discount rate, which is a risk-free rate plus an equity premium. So even if equity premium remains the same, because the risk-free rate has gone up, this denominator will go up. The discount factor goes up. Then also even cash flows themselves get impacted, because as interest rates go up, demand in the economy goes down. In fact, that is the whole purpose why central banks are increasing interest rates, in the hope that it puts a brake on demand and therefore on prices. So for businesses, also demand goes down, their interest cost goes up, so cash flows also come down. So if you look at this equation, the numerator comes down and the denominator goes up. So both ways it impacts the value negatively, broadly speaking. I mean, it will not happen for every single company, but the discount rate pretty much is across the board. Cash flows also in general will get negatively impacted. So that is what the impact of interest rate changes are. So now what happens? That it looks like the world is coming to an end, doesn't it? It looks like risks in the markets are sky high. But that is one way of looking at it. I mean, really, if you think about it, are the risks high now or were they high earlier? So go back 1 year, 2021 markets all around the world were booming. And if you remember, there were in India a whole lot of NASDAQ ETFs and funds launched. There were a whole lot of people that who opened accounts on Robinhood or some other brokerage and started spending their nights trading on the US markets, and most of them made money. Some even went into crypto and so on. So at that time, it appeared that you couldn't go wrong buying tech stocks, buying NASDAQ, buying Fangam, which everybody suddenly discovered that there are the 6 major tech companies in the US which you can buy. So it seemed very hunky-dory. At that time, I had mentioned something called recency bias when all these funds were being launched, which meant that you think whatever has happened in the recent past has always happened. So at that time, I had pointed out that if you look at the NASDAQ, for instance, just because the NASDAQ had done very well for 2 to 3 years prior to that, the impression in people's mind was that NASDAQ is always the outperformer, which is not the history. I mean, there was, for example, a period from 2003 to 2007 when the US markets didn't do well, emerging markets did well. So that was a recency bias then. Now the recency bias has turned on its head, and because NASDAQ has been about the worst performing market in the world, you suddenly think that all the risk is there, and in fact everywhere, and you should not be in NASDAQ and you should not be in equities also probably. But the real question to ask yourself is that where is the risk today? Is the risk being in the market and running the risk of a big crash and further hurt to your portfolio, further pain in your portfolio? Or is the risk actually on the other side? That what if you get out of the market or have already got out of the market and don't get back in? And you just sit it out and wait that when things will become more stable, outlook is better known, that is when I will think of equities again. So this was the question. And we started this exercise to look at what happens if you just miss out a few good days in a market. Few means really, really few, like, 1 day a year or even less than that. Will that have a material impact on your returns? I mean, generally, if you just sit and think, you will think, how much of a difference will that make? So, but when we actually started to do the numbers were so astounding. We actually checked them 2 or 3 times whether our calculations were correct. And then, I mean, once you think about it mathematically, I mean, they make all the sense. But intuitively, you had not thought that the difference would be so much of missing out. So this is an exercise that we did for the Indian market, and we did it for Sensex simply because Sensex has been around 40 years. So you have a clear 40 years of, a little over 40 years of data. It came into being in 1979. So you have that. And so if you had invested 100 rupees in 1979 and just kept it in the Sensex, that would be worth 44,000 rupees today. It sounds great. This is that famous 15% plus annualized return that everybody speaks of, that over the long term, that is the kind of return that you can expect because that is the historical return. So far, so good. But what if you had in these 40 years missed out not any great number, but only 10 good days, the 10 best days of the year, of this entire 40-year period? And suddenly that 44,000 comes down to 15,000. That is like 1/3 almost, just little over 1/3 of this number. So just by missing out on 10 good days, you have given up 2/3 of your returns. That is dramatic. And if you miss out 30 best days, which is still less than an average of 1 day a year, you are left with less than 4,000. So, you've given up over 90% of your return by just missing out the one good day in a year. This is very, very dramatic, very, very noteworthy. So therefore, the risk is also not just in being in a crash, the risk is of missing out the big up move day. And this is not a quirk of the Sensex. We did that same exercise for S&P 500. Of course, NASDAQ has not been around that long, and anyway, it's a more volatile index. So we did it for the more stable index, which is the S&P 500. And that has a nearly 100-year history, 95-year history. So there, if you start with $100, you end up today with $21,000, which sounds all fine. But if you miss out on just 25 best days, in 100 years, 25 days seems like nothing. Your returns come down by 90%. From 21,000, they come down to 2,100. In fact, if you miss out on 100 best days, which is virtually like 1 day a year average, you actually don't even make any money. That $100 declines to $38. Imagine. So the point is that it is not worth taking the chance of missing out on that big up move day. And also, both these graphs show us two things. That one, you can, as I said, you cannot make up for missing out on a big up move day. I mean, just look at it mathematically. The S&P has had several 9% up days. 9% up days, it has had 11% up days. So if you miss out on, let us say, just simply, let's say 10% up days, you have given up 27% of your return right there. So, and the other thing which we found when we actually did the granular analysis of which are the big up days and which are the big down days, which are the best days, which are the worst days, most of the up days, up move days come in the middle of a crisis. So they normally come after the market has crashed or done very poorly in the period leading up to it. And when everybody is in panic, that is when the big up move is likely to come, the very sharp up move. The only exception to this we have found was during that, which was an artificial market, which was the Harshad Mehta Teji. That was the only time where in a bull move you had big moves on a daily basis, on a one-day basis. So there were a handful of days there when you had a big move in a bull market. But normally in a bull market, there is no reason for the market to go up 8 or 10% in one day. The moves are much more gradual. But when it's coming out of a crash or a crisis or a panic situation, that is when you have a very sharp up move. And if you are on the sidelines, you get left on the sidelines. You don't participate. So that becomes the bigger risk to our mind, that can you afford to sit it out, especially when a big correction has happened. You're not at a situation where you are on a high. And so now that a lot of those negatives are already in the price, sure, I mean, US, I'm not saying that US economy is looking great and you will be able to manage inflation and yet grow very well, etc. But is it bad enough that it should be the very worst performing index in the world? So that is the trade-off you have to think of. And similarly in India, that you had a long period of underperformance. You just last year, you started to outperform. You've seen a correction. I don't know whether that up move day will be within a week, within a month, within 2 or 3 months. But now you are in a range where the risk of being left out of a big up move is more than the risk of a big downside. Of course, the downsides have to be managed. If you've followed us, we have always been big votaries of risk management. The other thing, of course, is that just being in the markets isn't good enough, because where you should be invested, that basket keeps changing. Since we started with this Sensex analysis, suppose you had held on to the original Sensex companies, it's not as if that you would have made the returns. Your 100 rupees would not have become 44,000 rupees with the original list. This is the original list. So you have the, Balarpurs and Bombay Burmas and, Mukund Steel and Hindustan Motors, Skindia Steamships. And let me also tell you, that it's not as if that these companies were unknown companies. Then, in fact, of this entire list, all these companies had been around decades even then. The only exception, I think, was Indian Hotels, which was a relatively new company. Even so, the longevity is not so much. So you probably, 1/3 to 40% of these companies are still of some significance, but the rest are either not there or not of great significance anymore. So you need to choose carefully, and you need to keep dynamically and tactically manage your asset allocation and your sectoral allocation, different companies. So that is one part of it. The other question, I mean, I'm just preempting, which I often get, is that what should we, suppose we get out of equity markets, where should we go? Should it be fixed income? Where in fixed income? So the thing is this, that you must look at your portfolio properly and decide what kind of asset allocation you want at a broad level. And after that, don't do too much of knee-jerk stuff that suddenly, I mean, equities have gone down, so let me get out of equities and get into fixed income, or vice versa, that last year equities are booming, so let me wind up all my bank fixed deposits and put it in the equity markets, or even put it in crypto trading. I mean, some people even did that, which was like absolutely crazy. So have a, think carefully what you want to do, and then remain there, because anyway, in equity markets, there is no point having a very short-term view. In fact, a friend of mine just 2 days ago was telling me that I have sold this ancestral property and I have this money. What should I do? I mean, I might need it after 6 months or a year when I find another property to buy. I said, there's only one place to be, which is bank fixed deposits, because in nothing else can you be sure of getting back even your principal when your time horizon is that short. So as of now, as we sit today, as we spoke about interest rates going up, fixed income is also not a safe place to be in, and which has played out globally and here, because as interest rates go up, bond prices come down. So if you look at the US bond indices, they have come down very dramatically this year. So it's not just the equity markets that have crashed, the bond have also crashed, and so also in other markets. So if you are whatever your fixed income allocation right now, I would say bank FDs are the safest place, because there you are locked into a return. You know exactly what you will get. Or you have very short tenure bond funds where again you hold it to maturity and you know what you will get. But otherwise, or floating rate, but otherwise normal fixed rate, even mutual funds, you are exposed to interest rate risk. So this was a bit of an aside. But coming back to where to invest in equity, as I said, that you cannot be locked into something forever. And if it sounds like too much work, that understanding too many things, deciding too many things, we have products that will cover your needs. So for that, I will hand it back to Achin, so he can just walk you through what products we have and what exactly we do and how we have done. Achin, over to you.
Absolutely. Thank you so much, Devina.
For now.
So, as far as our products are concerned, as a fund house, this is a decision that we've taken, that we don't want to be offering a proliferation of products. We don't offer all kinds of products like mid cap, large cap, small
Your
cap.
voice is breaking a bit. Your voice is breaking a bit.
Is it better now? Am I audible?
Yes, you are audible, Achin.
Fantastic. So we don't believe in offering a lot of products, a separate small cap portfolio, a separate mid cap portfolio.
No, again, there's some kind of echo. There's still some echo.
Let me check. Give me a moment, please. Is it fine now?
I can hear you properly, Achin. I mean, I think ma'am would be facing some problem.
Okay, so you were able to hear me
yes,
throughout.
Clear enough.
Okay, right. So that's the point, because when an investor comes to us with a problem of where to invest, we don't want to give him another problem that, look, here is our menu card of 20 products and choose what you want to invest in. Because the data shows, and there are studies that have been conducted on this, that a large part of your return actually comes from the top-down allocation, meaning which asset classes do you choose to invest in and which sectors do you choose to invest in. And I mean, if we are leaving that decision in the hands of the investor, then we are, not doing our job, right? Because what happens is, like Devina pointed out the example of a NASDAQ ETF. There were so many NASDAQ funds that had all of a sudden become popular in the last 2 years. Same goes for China equity ETFs. The problem with these narrow focused products is this. There are cycles. Each country, each asset class moves in cycles. And very often these products become popular at the worst possible time, after a run-up has already happened. And if you start investing in these products with that lag, then that investment is more often than not doomed for failure. And because the mandate of the fund is so narrow, the fund manager does not even have the flexibility of investing elsewhere, right? Which is why our products, we offer very, very few products, but very generic, very broad-based products, a very simple array of offerings, starting off with the India Super 50, which is offered under a PMS structure. It's an equity portfolio where we invest in a diversified basket of Indian stocks, where we look at different sectors, different market cap bands. Although, while we are on this topic, I'd like to highlight that within the India Super 50, our allocation to small caps is usually not more than 10 or 15%. Keeping in mind the fact that small caps, although they might look attractive at for lengths of time, but when the liquidity vanishes in these stocks, and people don't even find exits. So we are extremely wary of that. So that's the India Super 50, IS 50. And then we have the IMAP, which is the Indian Multi-Asset Allocation Portfolio. Once again, under the PMS structure, so that's a multi-asset offering where we have equities. The equities portfolio is exactly the same like the India Super 50. And then we have an overlay of fixed income commodities. So it's a lower volatility portfolio for anyone who does not want a 100% equity exposure. And then we have the FG Hum, which is a small case offering. So as you would know that the PMS has a minimum investment ticket size of 50 lakh rupees. So for a lot of investors who do not want to commit that kind of a capital to start off with, the FG Hum is similar to the India Super 50 in the sense that it's a pure equity portfolio, and it is driven by the same engine that drives the PMS portfolio. There are a few differences in the sense that the FG Hum consists of a lesser number of stocks. There's a hedging mechanism that we deploy in the India Super 50, which is not available in FG Hum because of the limitations of the platform. But at the core, it's the same engine. So it's a good starting point for anyone who wants to start their investment journey with us with a smaller investment amount initially. And then over time, you can graduate into the India Super 50. So that's all. These are our offerings in India. Very, very simple and encompassing a wide array of things that are being done within these products. Moving on to our global offerings, once again, very simple and very unique also. So we have the Global Freedom Fund and the GMAP, Global Multi-Asset Allocation Portfolio. Once again, both of them have similar engines, similar strategies. The difference is only in terms of the structure. The GFF is a fund structure and the GMAP is a PMS structure. It's a PMS run. It's a global PMS, right? So in both of these products, what you are getting is allocation to all asset classes across the world. So within the same product, you are able to invest in equities, fixed income, commodities, REITs, and globally, truly global. So a lot of the time you come across people who say that they are investing in the US and that to them is global investing. That is not global investing. US is still just one country in the world. True global investing is when and that is exactly what we do in these two products, is when you are able to invest across the world. So to give you an example, over the last couple of years, these products have held exposure all the way from US and Canada to China, Taiwan, South Korea, Japan, from Australia, Brazil, South Africa to Norway, Sweden, Saudi Arabia, all over the world. And the allocations are tactically and dynamically adjusted depending on what are the best performing areas at any point in time. So GFF, GMAP, GFF with a minimum ticket size of $100,000, GMAP with $10,000, both giving you global exposure. And just understand this, this kind of a truly global multi-asset product is usually very difficult to access even for people who are, large family offices who are investing $10 million plus amounts. And we have made these products available at an entry ticket of $10,000, which is truly, truly unique, not just in India, but really all over the world. So that's on our products. And about our performance. So this is the performance of our equity portfolio, the India Super 50. So the PMS had launched in late February 2020. Since then, we have beaten the Nifty 500 by a wide margin. Okay, and it's not just the benchmark that we've outperformed. We have outperformed every single multi-cap and large cap PMS portfolio in the country. Okay, since our launch. So this green line right at the top that you see, that's us, and then there's a huge gap. And then you have all the rest of the large cap, multi-cap PMS providers all clustered together. And we look at this data even more closely on the next slide. So this is a really important slide, and I'll spend a few minutes here. So, when people talk about performance of a portfolio or a fund manager, people talk about just returns. And returns obviously are very, very important. So let's look at returns first. So this column in green that you see here, this is the total return delivered by each one of these PMS schemes since our launch until May. So this is what, a 27-month period. And as you can see that we are far ahead of everyone else at 90% total return in this entire period. And what's unfortunate is that a lot of the names that you see here have not even matched Nifty 500 returns over this entire period. So be it White Oak, IFL, ASK, Alchemy, Marcellus, Axis, Motilal Oswal, Ambit, none of them have even matched Nifty 500 returns, let alone coming close to what we've delivered. But that's half the story. Returns are not everything. What's important is to understand what sort of risk is being taken to deliver these returns, because all return is not equal. You have to look at returns from the perspective of the risk that is being taken. And that is where, if you look at the risk adjusted returns of these portfolios, if you look at this column in red, which is a Sharpe ratio equivalent, that shows how far ahead of the rest of the pack we truly are. We are good on returns and we are fabulous on risk adjusted returns. If you look at the peer group, there's hardly anyone who's even half of our risk adjusted return. Okay, so this is return by volatility. Another way to measure risk adjusted return is the gain to pain ratio. So it's a very simple ratio, but very powerful. What it measures is the net return that the portfolio has delivered. That's your numerator. And then you divide it by the sum of all the losses. So all gross losses. So for example, in the 27-month period, if there were 7 losing months, you add up all the losses. That's the pain that the investor has to endure to enjoy the overall gains, right? So, and once again, what you see here, our gain to pain ratio is far, far ahead of anyone else. There's nobody even at 2, nobody even at 1.5. The next best, I think, is at 1.25, while we are at 2.13. And the last but equally important is how consistent are your returns. Okay, so we have outperformed the benchmark Nifty 500 the maximum number of occasions in this 27-month period. Okay, so high returns are great, but what's better is if those high returns are accompanied by lower volatility, lower drawdowns, and with consistency. And the reason why we are able to deliver this is because of the evolved human plus machine process that we have deployed, which means that this performance is not coming from any person's brainwave or just because you got lucky in a period. This is coming from a very, very rigorous process, which also means that this performance will be repeatable going forward as well. And we've drawn a similar comparison with the mutual fund space, taking all the top large cap, multi cap, and flexi cap mutual funds. And you see the performance, the comparison is similar. That green line on the top is once again us, and everyone else is lagging far behind. And that same table that we were looking at this time for the mutual funds. So once again, there is nobody that comes even close to what we've delivered, either on a pure returns basis or on a risk adjusted returns basis. And then moving on to the global products, the GFF and the GMAP. So this is the performance of our global strategies. These have been running for about a 7.5-year period now. So we've delivered a dollar CAGR of 10.7%, where the benchmark is between 5.7 and 7.4%. So steep outperformance even on that front. So that brings me to the end of this segment. if there are any questions, we have been receiving a lot of questions already. We'll be taking up all of those questions. If there are any other questions, please use the Q&A box to send out your questions, and we'll try to take as many as we can. So if I can start off with the questions, if you can just give me a minute, please. Right. So Gaurav Kucheria says that he agrees that it is not worth missing the best 30 days and it is impossible to predict this. But he's asking if there's any analysis on missing the worst 30 days. And he asks this out of academic interest. Devina, would you like to take this question?
I think you can take that, Achin, since I think the data will be with you. But we have done that exercise. In fact, I see in the chat box that a number of people have asked this question. More people have asked this, and we have done that exercise. And yes, it makes a big difference. So if you miss out those days, then your returns will be far higher than that 15% CAGR which you are talking about. And that is why, if any of you have been following us consistently, risk management is something that we emphasize a lot. We always say that if you can avoid a big drawdown, it really improves your returns. So that has always been the cornerstone. We say that whatever management fees you pay us, 60% is for risk management and 40% is for return management. So even what Achin spoke about in terms of all the risk adjusted returns being so much better, that is coming out of a deliberate process. And Achin can explain the process a bit better on how we manage risk.
Absolutely. So, like Devina mentioned, yes, we have done the other side of the analysis also. What happens if you miss out, if you are able to avoid the worst 30 days? So, Sensex 43-year history, if you remain invested from day one until now, your 100 rupees would have grown into 44,000 rupees as we had seen. And what we had also seen was if you miss out on the 30 best days, then your return goes down to below 4,000. Now, if you are able to avoid the 30 worst days, then instead of 44,000 rupees, you will be sitting on 5,42,000 rupees. So more than 10x. Okay. That's the upside of being able to avoid those worst days. And the way we try to avoid those, so I mean, it's obviously not possible to avoid each one of those big falls entirely. That's just not possible. But with intelligent risk management, what we can do is we can minimize the hurt and the damage on those bad days. And that is exactly what we try to achieve through our risk management that we talk about so often. Okay, so there are many different parts to this risk management, starting from the fact that we run diversified portfolios to position sizing, liquidity of the investment universe, where we do not invest in any illiquid assets, having protective stops, and
No, for example, I mean, just let me but in that on in our India IS 50, India Super 50, even when we know that small caps are going to do well, we don't take an outside risk on a small caps. We never go beyond 10 to 15% small caps, out of which we never go into micro caps. So nothing below 1,000 crore market cap, and 1,000 to 5,000, only maximum of 10 to 15%, that too on the liquid side of the small cap. So that is definitely one thing which we do. Yeah, Achin.
Yeah. And then we obviously have the tactical insurance for portfolio protection. Those of you who invested with us know how that works, where we buy insurance for the riskiest parts of the portfolio. And
yeah, I think somebody has asked about that, whether we still use options for hedging. So since we're talking about it, yes, we do. I think someone had asked that question, that whenever we think it's required, we do use options for hedging.
Yes, absolutely. So what all of this is geared towards exactly that, trying to minimize the damage on those bad days. And in March 2020, when the markets were down 30, 35, 40%, our portfolios were down less than 10%, thanks in part to some of these risk management measures. And more recently, on the 24th of February 2022, when the day when Russia invaded Ukraine, if you remember, the Nifty 500 on that particular day had fallen more than 5%. And because of the tight risk management that we deploy in our portfolios on that one day, when the Nifty had fallen 5%, we were down only 1.6%. So yes, we were not able to eliminate the full fall, but most of it. And all of those savings add up in the long run, as we've seen. The those If you're able to minimize the damage on those large fall days, it adds up really big time in the long run. So that's the answer to your question, Gaurav, and all the others who asked this. Devina, another question that we are getting is this. So, we mentioned that the list of stocks keeps changing. So we looked at the initial Sensex composition, and the composition today looks very different from what it was several years ago. So how does one determine, what's the best list of stocks to be investing in at any point in time?
So there's no simple answer to that, which is why we have this huge system to help us do that, which Achin and his team have over 1 million lines of code to help us get to that. And of course, the fundamentals are fundamentals. So you are looking at all the financials of the company, other information about the company, about the sector, about the economy. Except that that's a massive amount of data. And if you really want to optimize, rather than just that I am a fund manager and I understand these half a dozen things, then I will pick up something from these limited number of sectors. What we do is something where we start with the entire possible universe of companies which meet certain market cap and liquidity criteria, which in India is about 700 stocks. Globally, it is about 22,000 securities. And then we run our rigorous systems on that, which is what Achin and his team does on one end, at least on one of the systems. And then there are a whole lot of other overlays on that, including 30 years of human experience. And also our aim is over time also to codify a lot of that human experience into the systems. So out of all that, what we do is every quarter, we do a zero-based rebalance. So basically what that means is that if I had cash today, where would I invest it? It's another matter when we do that, most of the time, 85 to 90% of the stocks remain the same as what they were the previous quarter, because that also came out of a process. But we actually like to look at things with absolutely fresh eyes, at least every quarter. Achin, what would you like to add to that?
No, I think you've covered this fairly extensively, and we are always more than happy to go into details of how our systems work. But at a very high level, like Devina mentioned, it's a combination of humans plus machines, because there are a bunch of things that humans can do really well, and there are a lot of things that machines are very good at. And the edge lies in the ability to combine these two and deliver the best risk-adjusted returns for any market. There is a question next, so a lot of people are asking, what is the time frame you should be looking at if you're investing in equities right now?
I think anytime you invest in equities, at the least you should look at about 3 years, because below that, it is very difficult to predict that what will happen in 6 months or 1 year. Of course, your aim is always to make money and to outperform. But if you actually need the money a year later, then there is no assurance in equity. It is inherently a risky asset. So at least have a 3-4 year horizon. That would be my advice.
Absolutely. All right. one of the questions that has
you
been,
put up our social media handles. Okay.
yeah,
Yeah. Carry on.
yeah, one of the questions that has been asked is this, uh, for the GMAP and the GFF, the benchmark that we use is Bloomberg 60/40 and 80/20, but that's proprietary to Bloomberg and it's not available in the public domain. So what benchmarks should normal investors be looking at? And if I may add to that, would you also like to talk about whether or not 80/20 and 60/40 themselves are very appropriate benchmarks for the kind of strategy that we are running there?
Yeah, Achin, why don't you take
Sure,
this question?
absolutely. So it's a very relevant question that has been asked here. And the problem here is this, the strategy that we are running, it's we invest in equities, we invest in fixed income, commodities across the world. When we were launching these products, we scanned the entire list of indices offered by Bloomberg, MSCI, and surprisingly, there is no index that covers the entire spectrum. There is no index, and we were surprised. And Bloomberg 80/20 and 60/40 came closest to what we were doing. So the way Bloomberg 80/20, for example, works is it is 80% equities, 20% fixed income. That's fine. But the problem is even the 80% equities is only developed markets. It does not have any representation from emerging markets that our products do invest in. So what we've done is we've taken this up with Bloomberg and we are constructing a custom benchmark with them, which can serve as a good proxy for the kinds of products that we are running. Until that time, we are looking at the Bloomberg 80/20 and 60/40. For investors like yourself who do not have access to the Bloomberg 80/20 on a day-to-day basis, the best, there's no easy solution, but the best that you can do is you can look at separate indices to be tracking the performance of each one of them. So for example, you have the SPX and the Nasdaq. Everyone knows they track the US markets performance. Less popularly known is the emerging markets index, the EM index, that tells you how the emerging markets as a whole are doing. There are fixed income ETFs that are available depending on which category of fixed income you're trying to track. Then there are global ex-US indices, because very often the entire narrative around equities markets is dominated by equities so much, by the US so much that we forget that there's a very large world outside of the US also. So it's important, it's valuable to look at the global ex-US index, which is the ACWX. So if you go to, MSCI, for example, their family of indices for global markets are available on their website and the data is fairly easily available. So I understand it's a fair bit of work, but that's what it is. I hope that answers the question. We have a question about the FII selling impact. So, we keep hearing these stories that FIIs are selling so much, and this is the amount of selling that they're doing, and people get worried and scared that what will happen to markets. What's your take on that, Devina? I know that you have done some studies on the impact of FII selling in the past.
Yeah, so with the result that I don't even track it anymore. So, at a very broad level, without even going into week to week or month to month correlation, at a very broad level, many of you would not, most of you I'm sure would not have been in the markets then. But 1993 is when the FIIs were allowed to come into India. So 1993, Dr. Manmohan Singh was the finance minister. So he brought in a budget which allowed foreign portfolio investments into India. And that incidentally was the trigger for me to resign from my job in Citibank and set up this organization, because I said that now that the market is opening up, there will be room for professional research. But that's an aside. Now, 1993 is when the markets were opened up. So, towards the end of 1993 is when the FII started getting registered and started actually investing. Now, there is a 9-year period in the history of the Indian stock markets where the returns were zero. And that period is 1994 to 2003. So just when this new slew of money came in, and this was absolutely new source, and naturally billions of dollars came in over these 9 years, the markets went nowhere. And at that time, there was no domestic mutual fund industry. There you had only UTI and LIC to whatever extent as the domestic institutions. The retail investor was also not there to any great extent. And yet that market went nowhere with this new slew of money. So it really has, markets do what they have to do. It doesn't, it's a waste of your time and mental space to be tracking who is doing what. So please concentrate on the companies, the securities, the prospects for that, rather than who is buying or who's selling, because in the market, there are always enough buyers and sellers on both sides. And now, of course, the domestic market, DIIs are big, the retail investors themselves are significant. But even on a month-to-month basis, I remember even when the FIS had come in, obviously for the first few months and years, they were always net buyers. So this was a new source of money. But I remember the first month when the FII investment became negative, when they became net sellers, was a month in which the market went up. So that further proved to me that there was no correlation. So my advice to you is not to spend time on that. The TV channels have to spend time on it because they have to fill up those many hours of programming every day. So my other advice is that don't spend the inordinate amount of time watching business TV. Watch it to some extent, but watching different versions of the same story or reading different versions of the same story is not of much use. So go by news. Don't listen to everybody's views and everybody's tips, and many times there are agendas behind that. So spend your time, what time you have to spend, because obviously if you're not an investment portfolio professional, you're not spending 100% of your time managing your portfolio. So the time that you are spending, spend it on concrete stuff which actually helps your portfolio.
Sure. Absolutely makes a lot of sense, Devina. Arpan Gupta is asking, do your products invest in commodities apart from metals also? And do you do that only for global portfolios for India or India products like IMAP also?
Yeah, Achin, can you answer that specifically?
Yes, absolutely.
1 second. For a second.
So, Arpan, the global, the GMAP and the GFF portfolios invest in all kinds of commodities, not just metals. So, apart from the metals, we invest in oil, also all kinds of energy portfolios. And, so for example, if we are looking at an agri theme that is playing out, so we might not be investing in an ETF or a security that directly tracks these kinds of commodities, but we would be investing in securities that are linked to the performance of these commodities. So we take a fairly broad-based exposure even on the commodities side. India is more difficult because the number of instruments that are available that you can access is more limited. So, for example, gold you are able to invest in because there are funds and ETFs that track it. Silver has become only available now recently. Apart from that, there are not many commodities that are accessible to a structure in India. So that's a limitation there in India. But globally, it's a fairly wide catchment from which we construct the commodities sleeve of the portfolio as well. We have a question asking, can you discuss about your POWs and cap products also?
Okay, so I think that that's a little specialized for this audience because those are available only, at least the global ones are available only for global funds, not for ARS. So if you are interested, you can contact us at info. Can you just put out the contact slide once more? So you can contact us in any of these things through WhatsApp, through email. And in fact, even on social media, if you send us a DM or something, we will respond. But those are because derivatives are inherently leveraged products. So the RBI LRS scheme doesn't allow for that. But the cap is a capital preservation product. So we do have something like that for India also. And we will be offering it more formally soon.
Absolutely. So a question that a lot of people are asking, we keep getting so many news, so many updates about that in the last few days, cryptocurrency. So what are your thoughts on cryptocurrency investment?
So if any of you had read my articles last year, every time I always said that this is a highly volatile asset class. And Bitcoin, which has the longest history, has had multiple instances of 75 to 83, 84% drawdowns. So that was every single piece that I wrote on crypto. I mentioned that. And so what has happened now is not unprecedented by a long shot. And the other thing which I have always used to say, there are two other things. One, that crypto at the most can be the tarka to your dal, it can't be your dal. And the other was that a lot of people are jumping from absolutely low risk products like fixed deposits, not even going to equities and straight away going to crypto trading, which is a disastrous move. So many of those problems have come home to roost. So unfortunately, I mean, I hope not many of you have been hurt to a significant degree there. But that's the nature of the beast. I mean, it's a feature of the class. It is not something unexpected.
Sure. A question that is getting asked in many different ways is, so if people are willing to look at an investment horizon of 3 to 5 years, and then
Right.
some people are interested in knowing this for the more near term, for next 1 year. So over these different time frames, what sort of an asset allocation do you recommend, meaning equities versus other asset classes, India versus global? So, should they be investing in something like the IS50 or the GFF? What are your thoughts on that?
Okay, first of all, of course, the asset allocation cannot be one size fits all for everybody. So, I mean, depending on what your age is, what your goals are, when you're likely to need the money, it's all going to change. But I mean, in principle, you should have some amount in global also, because that clearly is something that I have learned, and we have all learned over a period of time, that you should not what we call scars, that we should not take single currency, single country, single asset risk. And I've given this example in the past. If you look at, you go back 25 years, you had that Asian crisis where Asian tigers, which were otherwise considered such great countries, suddenly had a period when their currencies crashed, their markets crashed, and in a matter of a year, uh, the worst was Indonesia, which was down 90%, but even the Taiwan and South Korea and all of those were down 50%. And that showed that being in a single market can wipe out your savings in one go. So that is the reason why I say that you should have global diversification also. That is important, because oftentimes happens that, for example, of late, that India does better, you say that let me move to India, or vice versa. But again, data shows that when you are chasing what has done well off late, that actually brings down your returns rather than enhances your returns. So, decide on an allocation and keep to it for a reasonable length of time. That would be my advice.
Absolutely. Sure. And there are a bunch of questions on the minimum investment size for various products. So I'll just repeat the minimum investment size for all the products. For the two PMS products, that is the India Super 50 and the IMAP, the minimum investment that we can take is 50 lakh rupees. That's the regulatory minimum by SEBI. By the way, the 50 lakh rupees can be split across the two products. So both of these put together needs to be 50 lakh rupees. For a small case, the minimum is around 2 lakh rupees. It varies depending on the prices of the stocks in the portfolio. Usually it is around 2 lakh rupees or slightly less than that. For the GFF, which is the global fund structure, it's $100,000 minimum. And for the GMAP, it's a $10,000 minimum. No, Devina, I mean, there are more questions than we can possibly take in the limited amount of time that we have. But there is one question that I would want to, because I always keep asking you this all the time. So I can imagine all of the people asking this. What are the books that you are reading right now?
In fact, Achin asked me this yesterday. So I had sent him a list of what I was reading. And I think you'll have that, Achin, somewhere.
Yes, I'll just bring that up.
Yeah. So I wrote about one of them recently in my LinkedIn post also, which is that short history of financial euphoria. Uh, and this is a very short book, in fact, very, very short book, 120 pages or something. But that is a good sort of tour of many of the big bubbles in financial history. So if you haven't read it, this is the easy read. So I would suggest that you read that. Then this book on price wars, which is very interesting because this is, again, commodity prices have become very, very central to all our lives recently. So it looks at many things related to that, along with the fact that the very fact that you are trading commodities as financial instruments when they have a real world role also can really distort markets. So, I mean, we are looking at it as a spreadsheet, as this is happening in wheat or something else. But, like one of my analysts was saying that in order to control inflation, you have to bring down demand. And I said that, like, you realize what bringing down demand in food means. That means people are starving. And that has all kinds of implications. It is the same thing in real estate also, for example, that you use real estate as a place to invest. It means it becomes out of reach for people who want to buy it as a home to live in. So that's an interesting thing. Daniel Kahneman, I have spoken often enough about his book, Thinking Fast and Slow. So if any of you have not read it, please do read it. I would highly recommend that. And this book, I've only part of the way through Noise. But again, very, very eye-opening, not surprisingly. So, for example, I mean, many things where you would think that experts should have the same view, for example, insurance premium. But if you actually do, even within an organization, ask people to come up with what's the right insurance premium, they come up with different numbers. So that's like one example of noise. There's a whole lot of other things where basically what you think is a rational number or a rational thought may vary very, very widely. So Invisible Women, this was a book that was a real eye-opener for me, that the whole world is defined and designed with essentially the default human being a man. So what does that mean? That women are not accounted for in a whole lot of things, from urban planning to drug trials to car design, and women are actually dying because of that, because the seat belt or the airbag is not designed for women. The drugs are not tested on women. Their symptoms of a heart attack are considered atypical, even though women are basically 50% of the world, but they are treated as if they are like a not normal minority. A very eye-opening book. I would recommend that everybody reads that. This demographics book, again, I have just started. This is someone's lifetime work on demographics and how it impacts everything, and especially the economics. So this is what I'm reading currently.
Absolutely. I mean, it's a remarkable spread of topics. So yeah, unfortunately I have to call it a day here. I know there have been a lot of questions. We've not been able to take all the questions, but you can always reach out to us on our email, and we will answer every single email that we get. So if there are any further questions, please reach out to us. And on that note, thank you so much, Devina, for taking the time for this webinar. And thank you so much, everyone, for attending. And it was fantastic.
And I hope you have found it interesting. I mean, we found this whole exercise very interesting and really surprising. So I hope you guys found it so too.
Thank you so much, Devina. Thank you so much, everyone. Thanks a lot.
Thank you.
We'll see you
Thanks,
again.
Achin.
Bye.